So in this video we're going to discuss about risk. In previous video we discussed about threats, that what basically a threat is. So a threat is actually measured according to its impact, right? And impact, or we can say that probability of risk, right? Because once you identify a vulnerability, then you talk more about how attacker convert a vulnerability and could be threat to the organization, right? Once you identify that vulnerability is actually a threat to your organization, right, then you started calculating. So a vulnerability then that cause threat, and if there is a threat, then you look for impact of risk, right? So this is how risk comes in picture. So risk is basically a potential loss, right? Why this is loss? Because it is exploiting the vulnerabilities that we discussed. So vulnerability is exploited, right? And with the help of that we calculate the risk, right? So basically a calculation of risk could be a threat into vulnerability into its impact, correct? Now this is how a risk should be calculated. Now look for the factors that cause risk. Okay, so the factors could be, let's take from basic, that if you have the outdated software. So how the software could be outdated? Because it is unpatched, right? The second could be misconfigured system. So the misconfigured system could be human error, or could be unidentified error. So could be, let's talk about open ports, right? The ports you are not using and it's open, and once the attacker identified that, could start attacking your system. The easiest one could be your user who is using weak password and no MFA is enabled. Okay, the next would be vendor vulnerability, that you have third party software and your vendor unable to identify the vulnerability and could be identified by the attacker. The next one and the last one is network segmentation. Network segmentation, the easiest part here is that you have your LAN network and you have your Wi-Fi network also. What sometimes the organization do is that they keep everything in one subnet, and because of that, uh, here under LAN they have all their servers also. So this Wi-Fi user also in the same subnet, and this is how once the attacker can get access, he just try to look by backdoors, or even they he's aware about the IP address and everything about that particular servers, and that could be the biggest vulnerability to the organization that could cause the critical risk to the organization. Now the most important part here is that types of risk. Risk is basically term as two types. One is quantitative and the other one is qualitative. Now the qualitative is about the calculation on the basis of low, medium and high impact, and qualitative works on basically the risk matrix. So the risk matrix is about that what is what is the probability that a risk is like, let's talk like in a simple word, that the risk matrix looks for probability, that what is the chances of this particular vulnerability to be attacked or expected to occur in the organization. Okay, so how likely it is that could happen to the organization. So this all qualitative discussion comes under risk matrix. So this is how calculation of low, medium and high impact. Then risk matrix where it is rarely happen, which is possibility, so it is possible, it is likely to occur. So this is all about the probability that how many times that this particular vulnerability will occur, and then what could be the losses in terms of qualitative basis, right? Now there is also one point to discuss here is impact. So impact is basically a severity, right? That what is the how severe it is, that what are the consequences of this particular qualitative of this particular risk, right? So that could represent as major, critical, then minor, moderate. So this is all about the severity of this qualitative risk, and based on that it is qualified. Okay, now we discuss about quantitative. So quantitative is all about a financial losses. A financial is all about a numerical value, and also the assessment should be done in terms of numerical value also, right? Okay, so if they calculate the risk, okay, uh, if they monetize it, okay, so that should be monetized on the basis of annual expectancy, okay, that that during an annual financial period how many times this risk can be occur. Then it also looks for the insurance and compliances of that particular risk to occur in the organization. So they are also prepared with the annual expectancy and the insurance and compliances record for this particular risk management, right? Also sometimes it calculated on the basis of for example, let's take a ransomware attack. Okay, so the ransomware attack that cost your user is $1 lakh, and if that happens twice a year, so your annual loss of expectancy should be 2000K per year, right? So this is how it is calculated on the basis of qualitative and quantitative factors.